Hi everyone, John Hardy here. I'm going to look at some of the post-Brexit behavior on some key charts. I think there are a few observations worth making here, even as some of the ranges have been expanded so violently that it's very difficult, I think, for all of us to select trading ranges. And one of the first things I would say is to avoid the sort of toxic volatility, if you will, in some of the sterling pairs. Because there is the potential with an announcement, an ad hoc development of a several hundred pip range. It's very difficult to hold on to positions there. Is to take a lower beta approach by picking an instrument like Eurodollar, where we could see some action that is a bit more muted relative to sterling pairs. And among those, of course, as I said, Eurodollar. So where are we looking at now? We've seen a bit of post Brexit settling. Let's start with the hourly. Usually I like to take a zoom out approach. But in this case, because we had so much volatility around the event itself, we can kind of look at the behavior here. 111 is marked so heavily because that's a 200-day moving average and near an old low. We saw a pretty decent bounce back towards, fell just short of 112. And that old 112 to 112.25 area was sort of where we broke down, and is also what I would call the upside pivot level. So if we're not able to stay below these kind of areas, 112.30, if you look at the 61.8%, it's really suggesting that we're risking this whole post-Brexit reaction unwinding. Theoretically, you still have a 76.4% above that at 113.05 ish, but to me, especially if you're closing, of course, above this level, we need to worry that the whole reaction has been overdone and for whatever reason is reversing. That is not our outlook. We prefer to look lower, respecting what has unfolded and keeping the focus lower. And where do we look there? Well, the immediate focus has been on this week has been on the 110.75 to 80 area. That was tested this morning. I'm not getting a lot of sellers up there, judging from the price action. I think there's an awful lot of uncertainty, but that is one area to get short. Leveraged positions are going to be getting uncomfortable already if I think if we're breaking above there and above this 111 area again. So there may be some tendency for stop outs above the, let's call it 38.2% retracement, not far above 111. And then again, these ultimate areas up here. So there's sort of two phases where that gets the bears into trouble. Now looking to the downside on where we could head there, let's have a look at our daily. And I think what I like to look at is not necessarily the Fibos. We did see that Fibo back here, this low here to the high here, tested just above 109. It's more the traffic areas where there was a lot of price action before that I would look next. And in that case, 108. Now, if we do look at Eurodollar on a weekly chart, I color the bars differently from my weeklies just to remind myself that I am looking at a weekly chart, not a daily, which I consistently have as light blue. That's just one of my idiosyncratic setups. We do have a trend line. I'm not big on trend lines when they're as shallow as this one is, and when we have clearly what is more of a range in 105-ish being the key low there. So you're going to have to work through the 108 zone again, and then we're talking about the ultimate lows for the cycle. I do expect those to be eventually tested as we head into existential problems with the EU if the Brexit proceeds, with an Article 50 being invoked. Now, I will take a brief glance at cable, but just to remind viewers, I think the risks of trading cable and other sterling pairs are quite large, given, for example, an Asian session where you see 200 pips of a bounce. I'm considering this a dead cat bounce, but a dead cat can have an awful lot of bounce when you're talking about a 1500 pip plus trading range. Actually, with yesterday's low near 131, we're talking about 1800 pips since the 150, remarkable 150 highs when the market was really leaning the wrong way. So I think ultimate resistance zone is 138, which was the prior low. And you see the local low at 140. That's the zone, and we saw that tested near the 140 level post the incredible avalanche in the wake of when it became clear that a Brexit was going to happen. So 140, the ultimate resistance, 138 is where the zone starts, and that's 500 to 700 pips away. It gives you an idea of the potential for volatility, and you're, even at those levels, you're not talking about a reversal of the move itself. It makes it difficult to find entries. Leveraged positions are going to be looking at probably more like 135, perhaps those little highs we saw here early in the week to open the week, a little bit ahead of 135. And again, on the longer term charts, if we look at cable, we've hit these new lows going back a generation to the mid 1980s. There was an incredible spike low of 105 back at that point in time, but you're not talking about technical levels at this point. You're talking about, is this a secular decline and repricing that means something. It means bigger adjustments lower, and I think we're just looking at round figures from here, 130, 125, and so on, if the march lower does continue. I think for dollar yen, it's very difficult, obviously, with the risks of intervention for the market to decide what it wants to do. To me, just judging from price action alone and from some experience looking at this in previous markets, we may or may not have had an intervention on the initial spike in the wake of the Brexit. If you look at some of the other yen pairs, that there might have been intervention to sort of shore up confidence. To me, the subsequent action does not look like we're seeing intervention. If I go to dollar yen on the hourly, you're just not seeing the kinds of tremendous spikes and retreat in the wake of this. Of course, initial cataclysmic event. And where is that intervention going to come in? I think it's very tough to say, but 100 has to be a psychological level. I think it's more important to look at the chart and to see at points where intervention, it suspiciously looks like intervention. In other words, 5-minute bars, we're clearly seeing a very aberrant price action of a couple hundred pips that is immediately sort of retraced within minutes of it unfolding. Other Brexit impacted and risk appetite impacted pairs of the commodity currencies versus the dollar. If we have a brief look at some of these, quite interesting. Again, we saw quite a ramp from those May lows going into the UK referendum vote. Some of that driven by a quite dovish Fed, the Fed meeting coming in around here, and then of course the expectations of a Brexit not happening, a remain happening, and then of course the Brexit saw that unwound. So we have the initial shock. There's some argument if markets can stabilize, if risk appetite can get back on its feet, you've got sort of the pent up Fed dovishness as a possible theme to drive dollar weakness. But I have a hard time buying the dollar weakness story. And would prefer to sell riskier currencies, including the Aussie. But we have not seen the technical sort of follow through. So we had the initial shock, and we're going to need, you can see this area here, it's quite evident on the charts. We need to get some follow through these sort of lows here, 72.50 to 73 area, the 200-day moving average coming in around the 72.85 area. Another follow through, and then we're testing these lows. It's been quite technical, some of the action here. As you can see from some Fibonacci levels, there was a lot of traffic around the 618. So we need to see it following through these lows. To me, the chart looks bearish on a follow through as an initial trading sort of trigger through the 200-day moving average here, and then adding on to positions if we're continue to see sort of a widening of the contagion from Brexit and risk off, and a negative focus on China, for example, and Aussie dollar following through these lows. Similar picture for Kiwi dollar, for dollar Canada. I won't cover those here. So this is a little bit of an attempt to get back doing some chart videos, and I think I'll call it quits there, and we'll have future videos, of course, that you can look at, and we'll also discuss at times, I think, more general trading tactics and the way I look at charts in the future. So I hope you enjoyed, and we'll be back next time quite soon, I hope. Thanks.